Say you have $10,000 you want to invest in a stock. Should you buy it all at once, which is lump sum investing, or should you buy it slowly over time, which is dollar cost averaging? In this video, we'll look at dollar cost averaging versus lump sum investing to determine which is the best investing option, and we're starting now. How's it going, everybody? Welcome back to the channel. If it's your first time here, my name is Jay, and on this channel, I take my over 20 years of investing experience and use it to bring you all the tools, the tips, and the tactics that you need to get the most out of your money. And today, we're talking about dollar cost averaging versus lump sum investing when you have an amount of money that you're ready to invest in an investment. So let's get the formalities out of the way first. What is lump sum investing? And it's exactly what it sounds like. You have a sum of money that you want to invest, say $100, $1,000, $10,000, $100,000. You take that lump sum of money and you invest it all at one time into whatever stock or mutual fund or ETF that you want to buy. So if I have $10,000, I want to buy Apple, lump sum investing, I buy $10,000 of Apple stock all at once. And what is dollar cost averaging? Well, dollar cost averaging is when you have $10,000 that you want to buy in Apple stock, but instead of investing it all at once, you decide, I'm going to invest my $10,000 over the next 10 months. So every month I invest $1,000 in Apple, and by the end of those 10 months, I have invested my $10,000. It's important to note that if you're going to dollar cost average, there are no hard and fast rules. You can do it with any amount over any time period you want. What's important is that from whatever the final amount you want to have in the investment, you invest even increments of money at even increments of time. That could be days, weeks, months, or even years. And the theory behind dollar cost averaging is you're spreading your risk out. If I'm spreading my investment out over a number of weeks or months or years, I'm smoothing out the risk. So I'm buying fewer shares of my investment when, the prices are at their peak, and I'm buying more shares of the investment when prices are at the bottom. So how does dollar cost averaging work compared to lump sum investing? Let's take a look at a quick example. Okay, so say we have $5,000 that we're ready to invest in the latest hot stock called Shmamazam. So with dollar cost averaging, I decide I want to spread out my investment in Shmamazam. I'm going to invest $1,000 every month. So in month one, I take my $1,000. Shmamazam is trading at $40 per share. So my $1,000 at $40 per share gets me 25 shares in the first month. Now the next month, the stock had some bad news. The share price goes all the way down to $20, but I'm still investing my $1,000 per month. So in the second month, my $1,000 gets me 50 shares at $20 per share. Now the third month, they start to recover a little. Shmamazam's business is picking up. I'm still investing my $1,000 a month. So the stock price has recovered to $25. So in the third month, I'm getting 40 shares of Shmamazam for my $1,000 at $25 per share. Now in the fourth month, the stock price has completely recovered. We're back up to $40 per share. Again, I invest my $1,000 and it gets me another 25 shares. And finally, we come to the fifth month. Business has been good. Shmamazam is reeling in the profits. Their stock price has risen to $50 per share. I still invest another $1,000, gets me another 20 shares. So I've invested $5,000. I've done it $1,000 per month at different share prices. And at the end of those 5 months, I end up holding 160 shares of Shmamazam, but my average price of my investment works out to be $35 per share on my investments. So you see, that's why they call it dollar cost averaging. We're literally averaging our cost into the investment at different prices. So we get 160 shares at a $35 average share price. Now, if we had that $5,000 and we wanted to invest it as a lump sum, if we invested it all in that first month, we'd only have 125 shares of Shmamazon, and our average price would be $40 per share. But if we invested that lump sum at the best time when their stock price was depressed down to $20, we would have ended up with 250 shares at a $20 share price. So you can see by dollar cost averaging, we got more shares of Shmamazon when the price was really low, we got fewer shares when the price was at its peak, and we kind of smoothed out the graph, if you will. We didn't have to have perfect timing buying at $20 per share, and we're not regretting putting all our money in at the top at $40 per share. And that leads me right into what are the pros of dollar cost averaging versus lump sum investing. And the very first one is that dollar cost averaging removes any of that "am I getting the best price" doubt that you may have when buying a stock. By easing your way into the investment over a set time period, you don't have to worry about whether the price right now, right today, is the best one you're ever going to get. And it's a really useful strategy for either volatile investments or a volatile market in general, because it takes away that risk of bad timing, because you are building your position at even intervals over a period of time. Another pro to dollar cost averaging versus lump sum investing is not everyone has a lump sum to invest. You can look at the $0 to $100,000 portfolio I'm building on this channel. I don't have $100,000 just to drop in the portfolio and invest all at once. So I'm investing in regular increments and dollar cost averaging my way into building up this portfolio. You're probably doing something similar with your 401k plan. In your 401k plan, your employer is taking out your contribution every week or 2 weeks or however much you get paid and investing that money at regular intervals. So if you have a 401k, you're already dollar cost averaging. And another big benefit to dollar cost averaging versus investing a lump sum is dollar cost averaging removes the emotional component to investing. And removing emotion from investing is probably the best thing you can do to become a better investor. Ben Graham, author of The Intelligent Investor and famously Warren Buffett's mentor, has a great quote about this. He says, and I quote, "The investor's chief problem and his worst enemy is likely to be himself. In the end, how your investments behave is much less important than how you behave." So what he's getting at there is something we've mentioned on this channel a lot, is we as humans are our own worst enemy when it comes to investing. We get too giddy and we get FOMO when the markets are at highs and we end up buying high, and then when the market crashes and it tanks, we get scared, we get worried, we panic, and we end up selling when the prices are at the bottom, when really, we all know it should be the opposite, but emotions take over, people do dumb things. One of the best ways I know of dollar cost averaging is by asking you to both like this video and subscribe to my channel. They both help out immensely, but I know some people only do one, some people only do other, and a lot of you won't do either. And what's up with that? But really, if you could like and subscribe, I'd greatly appreciate it. It helps out the channel. So now let's look at the cons of dollar cost averaging versus lump sum investing. And if you do any research into this topic, you'll see there are plenty of studies out there that show lump sum investing performs better than dollar cost averaging. So basically, lump sum investing all at once, will probably give you a higher ROI on your investment than dollar cost averaging. And this is for a couple of pretty obvious reasons. Number one is that over the long term, stocks tend to trend up and to the right. The stock market rises gradually over time. And like I love to say in all these videos, time in the market beats timing the market. So the quicker you're getting your investment into the market and working, the quicker you're earning those returns and the quicker your investment is growing. The other reason for lump sum investing performing better than dollar cost averaging is what they call cash drag. So if you have a large lump sum to invest and you choose to dollar cost average, the amount in cash that you have sitting on the sidelines earning little to no interest compared to what it would in the markets kind of drags down your overall returns, especially at the beginning of your dollar cost averaging when the cash outweighs the invested portion. But again, not everyone has a gigantic lump sum to invest, so the factor of the cash drag on your investment is probably only a major factor if you really have a large lump sum that you're looking to invest. So we've established some reasons why you may want to dollar cost average, and we've established that lump sum investing is probably get you the best returns. So which one should you choose? And personally, I think dollar cost averaging still wins. The reason being is that all those examples of lump sum investing winning are very true in a vacuum, but we live in the real world. And I'm going to go back to a point I made towards the beginning of this video, is that dollar cost averaging takes out the human error and takes out the emotional component of investing. So regardless of the amount of the lump sum that you have to invest, removing that emotion is a huge factor. I've been investing for over 20 years, and every time I go to hit the buy button on a stock or even one of my index funds or ETFs, I still get that little voice in the back of my head saying, wait, can we get a better price in 5 minutes? Will we get a better price tomorrow? And dollar cost averaging shuts that little voice up. You don't have to listen to it. So really, it comes down to individual preference, whether you want to dollar cost average or lump sum invest. If you enjoyed this video, I've got 2 more right over here that I hope you click on. Be sure to like this video, be sure to subscribe to the channel, and I hope to see you in one of those videos.